This TwinPetes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the TwinPetes Investing podcast. This is podcast number 65. The date is the 29th of December 2021. I'm hoping you, ladies and gents, have had a fantastic Christmas. You've had a great time with friends and family. And if you're like me, you've enjoyed lots of mince pies. I'm here today with my great friend, Peter, at WheelieDealer on Twitter. My name is Peter Higgins. I'm at Conquers3 on Twitter. And first and foremost, I want to thank all of you, ladies and gents, from Australia, Canada, America, the UK, and across Europe, who gave us such fantastic feedback with regards to our interview that we did going back now. I think it was on the 15th of December with Katarina Ali at _MTAUS. The feedback we've had for that is absolutely phenomenal, including one that Pete got from the one and only Rosie Carr, the current editor of the Investors Chronicle. Pete, how did you feel about that, mate?
Do you know what? Well, hello everyone. Do you know what? It blew me away when she sent it. What really sort of hit me between the eyes was what she said. Is how her 20-year-old daughter had been sort of walking through the living room and heard it and sort of said, "Well, who's this? You know, what's that about?" And got really interested in it. So it's fantastic that you know, that can inspire someone so young, sort of thing.
I think we've had so many interactions with people about this particular podcast, Pete, and it was one of those. And I love Kat's energy. I love her drive. I love her passion for learning. But some of the topics we talked about were Marmite. Okay, you either loved it or you loathed it. And we covered NFTs, we covered metaverse, we covered stuff completely alien to so many people. But some people were open to actually just listening to something completely new. You know, and it's like, oh, what's that all about? You know, it's that curiosity which always triggers some of us in a positive way, but also triggers some other people in a very negative way. But I think, you know, from what I've seen,
not necessarily a negative way, as a sort of skeptical way. And I think with a lot of this stuff, it's actually good to be skeptical. But as I've said on many tweets and things, I think there is something in, you know, a lot of this stuff. I think there is going to be a lot in it, and I'm sort of very alert to investment opportunities in it. But of course, it's just finding the right one, isn't it?
Absolutely. I mean, I'm going to go back to the tweet from Rosie Carr at Investors Chronicle, and she wrote, "TwinPetes Investing podcast number 64, part 1," and then gave the link to the tweet to the podcast. "My 20-year-old daughter, not known to be a fan of investing podcasts, absolutely loved this episode. Her first listen of a Twin Petes show, full stop. She's right. It's excellent." I mean, you know, we weren't talking, you know, to use the term vanilla stocks here. We're talking a multitude of things which were completely new for the new listening ear as well. You know, we weren't just talking about stocks, funds, you know, etc., etc. We're talking about lots of different things, Pete, including Bitcoin and NFTs and all the rest of it.
Well, I think that's the thing. It's like, you know, when I started doing the whole WheelieDealer thing, which is incredibly sort of like 7 years ago, I very much wanted to pitch it at newbies, you know. So the idea that now I'm involved in the podcast with you and we're getting 20-year-olds, you know, taking notice, that's fantastic. I'm so pleased that that's happening.
The thing for me, Pete, one of the main driving things about that podcast for me was the fact that Katarina was talking about women being independent, women being financially sound, women standing on their own, you know what I mean? And being able to financially know that whatever comes their way, I'm going to be okay. I'm going to be all right. I'll be able to look after myself. I'm not reliant on anybody else but themselves. And for me, I think that's what probably struck a chord with Rosie's daughter. having somebody speaking that way and so passionately about, I can do this, I'm going to be all right on my own, I'm going to be okay financially, I'm going to make sure that my pension's sorted, I'm going to make sure that financially my bank account's sorted, I'm going to make sure that, if need be, I can afford my own house. I'm not going to allow my pension to be eroded by the fact that I may take time off my career ladder to do other things. I think that's what struck a chord with lots of people, including lots of our female listeners. And whilst we're talking about the females and women, let me just reiterate that I always use, because we had some kickback for Pete using a certain term, which I'm not going to repeat on the show. I always use ladies, gents, females, women, and I will always continue to use that. I don't use other terms, because that's what I've been brought up to use. So for other people, that might be okay to use other terms. It's not okay with me. Pete uses another term, which I don't agree with, but Pete is Pete. And if you've got a bone to pick with Pete, pick him up on that. Fine. But you've got to remember that the purpose of this show is to educate people, and we will make mistakes. We'll say things that will jar with other people. We're not going to appease everybody, but when we make a mistake, or when I make a mistake, I will always, always, always hold my hand up.
Well, I'm trying not to, because I've basically got myself in a whole load of trouble trying to avoid being in trouble. But anyway, mate, let's not go there for safety's sake.
Whilst I'm on the issue of mistakes, we've got an avid listener. And his account is John at F15JCM. Avid listener, listens all the time.
Hi, John.
Very rarely interacts with me, but he rightfully pointed out a mistake that I made in 64, where I said that the FTSE was still down for the year. Yeah, John, you're absolutely spot on. When we recorded this podcast on the 15th, I was wrong. The FTSE was up for the year, and it was up 10-11% at the time, and I was still struck back in when I was recording previous podcasts when it was still negative for the year. But you're right, it was up, and it continues to be up for the year, and we've had a bit of a rally, which I'll talk about a bit later. But thank you, John, for pointing that out. Much appreciate your feedback. Thank you for continuing listening, and thank you for pointing that out to us. Thank you.
Cool.
So, Pete, what else do you want to say about that particular podcast, mate?
Well, I think we've pretty much covered it, mate. We probably time to move on to a quick bit of chat about the markets.
What I was going to say was, all of the feedback we've had for all of the shows that we've had, I always pick out X amount of number of feedbacks that we get, and it's in the write-up. So the write-up, or most of the feedback we got from Kat, I added into the write-up for TwinPetes 64 Part 2. We've already published that, and some of the podcast feedback we've had for Kat and for 64 Part 2, I'm going to be putting into the write-up for this podcast, which is podcast number 65. So you'll all be able to see what good, bad, and indifferent feedback we've had.
So that's on your website,
that's going to be going in the write-up on my website, yes, and all the links that we put out for the full podcast when it goes out, which will probably be Friday the 31st now.
Cool, sounds good.
Okay, Pete. So we asked some readers and listeners to come back to us, and the last podcast we said, look, you know what? We're going to talk about some of our mistakes, talk about some of the performance that we've had regarding 2020. It's been a very, very difficult, problematic, enduring, testing, hard year for most of us as investors. And we got some fantastic feedback, which we're going to talk about a bit later on. But you wanted to talk first about your performance and some of the feedback you wanted to give regarding how things have done for yourself, Pete, first, didn't you?
Well, yeah. I mean, it's funny because, do you know what? I think I might have mentioned this on a podcast before, and I've certainly mentioned it on tweets. I feel quite disappointed about this year in terms of my performance, But if I am objective and rational about it, it's actually been an okay year. And I mean, it's been helped by recent days. The fact we've had this bit of a drift up has really helped me. That's kept things improving. But yeah, so I mean, as it turns out, I'm up probably about around sort of 13% on my sort of base portfolio. But then because I use leverage, so really we need to look at the return on the capital employed, which allows for the fact that that I borrow some money effectively by using leverage, using spread bets. And my actual return on capital employed is 17% at the moment. I think I'm going to finish around those kind of figures, 13 and 17. If you break that down, my ISA, my spread bet portfolio has underperformed again. I always get this problem every year, and every year I say the same damn thing. And but overall, my ISA's up about 19%. So I've actually had a pretty good year, really, if I'm honest. And then the other thing that kicks in is my income portfolio, which is like that separate portfolio. It's all listed on my website and stuff. The separate that's up 11%, I think, roughly. It might even be better than that because of recent days, which again is pretty good, really. So the disappointment is because we were doing so well, 3 or 4 months ago. Things were so strong, and I was on target for maybe getting to sort of 20% return on exposure and sort of maybe as much as 30% return on capital, which would have been an exceptionally good year. But sadly, it's dropped away from that. But, I can't really complain. It's actually better than last year for me. And last year I did all right. So yeah, weird year, really.
It's an interesting one, Pete. I think as we said in the last podcast, I think a lot of people's portfolio performance rolled over from the summer. And I think that's because a lot of the momentum stocks that were juiced up just lost momentum, but also the worries as we got into September and October regarding supply chain issues, and then the latter part of November, December started talking about COVID. Then Omicron got spoken about. So a lot of portfolios started to wilt on the vine as such. But you've done really, really well there. I mean, the thing that concerns me, Pete, is once again, you as you've rightfully pointed out, is that your spread bet account and your hedging cost you. That's the impression I'm getting again. And
well, it didn't, in the sense that without the hedging, I'm only up. Well, actually, no, you're right. Yeah, no, actually, you're right, because if I just did it on pure stocks, I'm up 19%. But then if you allow for the extra exposure that is in the long spread bet portfolio, then yes, it pulls it back to 13%. But then again, it's not an exact like for like, because
I get that.
In the spread bet portfolio, I've also got stocks that I hold in the income portfolio. So it's sort of a bit, it's not quite as simple. I've spent a lot of time thinking about it. I think one of the areas where my spread bet account has suffered this year is that I had a big position in PayPal. The reason I had a big position in PayPal was because it got around the currency risk, yeah? But the problem is that was all great when it was going brilliant, but when PayPal got smacked recently, it disproportionately hurt the performance of the spread bet account. So I think that has had a real negative effect on it. The other complication with the spread bet account is that, by definition, all my hedge trades are done in my spread bet account, yeah? Now, if I don't need those hedge trades and they get closed out and I take a small loss, that loss goes against that spread bet account.
Of course, yeah.
So the spread bet account is always, one of the things I really tried to do this year was only hedge when I really need to, yeah? And I think I was pretty good at that. And I probably put about, say, 3 or 4 times during the year where I placed the hedge. It's probably about right. And I didn't need them. And the good thing I did do was I closed them out quickly. So they were only a small hit. But they were a small hit to the overall portfolio, but they were quite a hit to the spread bet account. So it's getting these disproportionate hits. And we come back to the big problem I made this year, something I talked about on another podcast, I think, where back in October or whenever it was, yeah, I got the timing absolutely spot on, right? I said these markets are going to drop. I was looking for that in the charts. I could see it starting. I got hedges on, yeah. but I used the FTSE 100. What actually happened was that the FTSE 100 didn't really drop much. It sort of dropped a little. So my spread bet short went into profit. Then it sort of like started moving up again. And of course, then I started getting into a loss situation and I closed the spread bet. But the problem is, if I'd shorted the FTSE 250 instead, I've actually potentially could have made a big gain on that because really it fell. The FTSE 250 pretty much fell from October all the way through to mid-December. It was flipping awful. And looking at the way the chart went, I mean, obviously it's hindsight bias, but I think the bottom line is, had I shorted using the FTSE 250, things would have been very different. And obviously that would have helped the spread bet account rather than hindering the spread bet account. So that's the big learning point for me this year, is that in the future I'm going to start using the FTSE 250. And the reason is it matches my long portfolio better.
Yeah, I mean, we had a very interesting summer really with the FTSE. I know we've got 2 more days left ish. We were there in the middle of July at 7,120 odd, and then we had that summer blip where 2 weeks where we just went sub 7,000 at 6,840 ish around the 19th of July, and then it rocketed from there, and we went up to 7,200, Pete, and more in the middle of August. And then between August, it dropped, right, from 7,220 odd.
Yeah.
We just went sideways, then dropped again down to endish towards the latter part of September. We went sub 7,000 again at 6,903-ish. And then it just went sideways before it started to move again in October. And from October, where we were around the 6th, we were sub 7,000 still. It climbed all the way up to 7. That's when we got our high in November. And everyone was saying the Christmas rallies come early, sort of thing. 11th of November, we hit what was then the 52-week high at 7,384. Yeah, and then with all the negative noise started again. COVID. Lockdowns coming, Boris is going to do this, that and the other. 26th of November, we're at 7,000 and hoping and praying we're going to hold on to 7,000. We're at 7,044 on the 26th of November. Yeah. And since then, we've gone up. First beginning of December, everyone's thinking the early rally started. We've got 7,339. We didn't quite take out the 7,384 high, 52-week high. And then last 2 weeks, mate, we've just been like, oh, is it coming? Is it not coming? And we ended up down towards 7,000, sub 7,200 again. And it's only just in the past couple of days, mate, that we've had a rally move, and we've actually taken out the 52-week high of 7,384, and we actually did that today, and we closed at 7,420. Yeah, so that's what's happened regarding that, Pete. And the reason why I said about the hedges, Pete, because if you had done nothing regarding hedging at all and just managed your portfolio, I think you probably would have had another plus or 3%, 3 to 5% across your portfolio. That's my thinking.
Well, I think actually, I mean, I've got the actual hits that I took from the hedges, and I doubt they add up to more than 3%. They're all written down on my website. I was taking hits of about 0.3% of the portfolio, 0.4%. They were small hits,
Okay.
So I was getting out of them early, which is something I'm really pleased. Nearly every time, I think every time, when I could see it wasn't working, I got out of the trade, and I didn't run it. I didn't even let it run to the stop loss. Mm-hmm. So I'm pleased. I think that was good discipline. I'm pleased I did that well. So I don't think it hit it that much. What did hit was the fact I was using the wrong index.
The wrong index. Okay.
And it brings me back to another intriguing aspect. I don't know why my laptop keeps shutting off today. When your laptop, the screen shuts down and goes dark. It keeps doing that today, and it's really unnerving me because I sort of don't feel. I always think, well, it's going to kill the call, It
needs to be on a longer sort of time frame, Pete. Whether it's 15 minutes or whatever, without any attention.
No, it's never done this before. It's the first podcast we're recording. It's done anyway. What has really amazed me is that, well, I mean, it makes sense because my income portfolio, which sadly is only a small part of my overall sort of stuff in the market, my income portfolio is largely composed of big FTSE 100 stocks. So it's got like HSBC, RDSB, GSK, AZN. I mean, AZN's had a massive impact on the FTSE 100 this year because it's a big weighting. So it does tend to move with the FTSE 100. And the benefit of that has been that while my normal portfolio was suffering through the last few months sort of thing, my income portfolio actually held up really well. So that again plays to this idea of having the diversification. It gives me another good justification as to why I have a separate income portfolio.
No, that makes complete sense, mate. I get that. I mean, I'm looking at the charts for the FTSE 100 and the FTSE 350 and the FTSE All Share, and they're all there or thereabouts, having travelled about 11 to 13%. I'm just crudely looking at it, so it's not exact, and that's what it's done year to date. So yeah, that's pretty good, really, if you think about it, chart wise. And if anyone's done that 13% this year, then absolutely you've probably done quite well, because most people are looking for between 5 and 10% for the year. So anybody that's exceeded 10% and got 13% have done extremely well. So yeah, so you should be pleased with that, I think. Pete?
Yeah, I mean, I always say my target is 10%. As long as I'm achieving 10%, really, I've got to be happy. But like I said, I think it's just this sort of disappointment. I was doing so well a few months ago that sort of has sort of weighed on my psyche, you know. But as I say, objectively, it looks like, you know, we've still got 1.5 days to go. Is it half day on Friday?
I believe so. Yeah.
Yeah, so we've still got 1.5 days to go.
Yeah, I haven't actually checked it, but I believe so. I could be wrong. But like all things, I always stand up to be wrong. So,
yeah, I'm pretty sure it is. So you know, so we've got another 1.5 days to go, and fingers crossed. Hopefully, I'm going to come out looking okay, and you know, it's actually been quite a good year. So, you know, in terms of pound notes, I've done pretty well. So, you know, when you...
I mean, the FTSE popped. I think it was like 2 days of people sat there the weekend going, is the market open on Monday? Is the market open on Tuesday? It's like, no. And then today it just came out of the traps, mate. We got to about 9 o'clock-ish, and the FTSE 100 was at 7,457, Pete. You know, so that's a really good move, with people just wanting to get back and buy some stuff. Obviously, volume is lower than normal, but yeah, the market's got off to a really good start. So let's see what happens tomorrow and Friday.
Yeah,
and for the beginning of the new year, because everyone's going to be coming out with new ideas and suggestions regarding the markets. But Pete, sorry, go on.
Just because say interesting, just a quick one to bang in. That yet again, the Santa rally has actually worked.
Yeah, it has.
And I'm kicking myself because I didn't do it, because I was so worried about COVID, and I thought, well, I've got loads of stocks anyway. I'm 100% long anyway. I'm not that bothered, you know. But of course, as it's turned out, I'm sort of thinking, shit, but excuse my French, why didn't I do it, you know?
Yeah, I mean, as we said, you know, the latter part of December is when it kicks off. We're hoping it kicks off, but I said in the last podcast, I was very cautious. I didn't think it was going to happen. I didn't think we'd take out the high, which is what we've just finally taken it out. And that's because Boris decided to not do anything on Monday and said to people, carry on. You know, so whether or not he'll wait until the new year to come and kick us where it hurts, I don't know. So I'm still quietly cautious. We'll see what happens. Will we get some follow through tomorrow? Will it stay above 7,400? I hope so, because a lot of portfolios could do with the help.
Oh yeah, definitely. I mean, sort of looking forward, and we talked about this on the last podcast. What I tend to see every year is that you get into the start of January and it's sort of all right, and then it has a little bit of a dip, and then it sort of tends to be all right through January, February, and then the time to get worried is sort of towards the end of February, sort of March time. And I read something today in Investors Chronicle, yeah, which sort of like, I think I've seen elsewhere, but it sort of like really hammered it home. You know that Case-Shiller
Case-Shiller index?
Yeah, the CAPE index, the cyclically adjusted PE ratio thing. It's reading 39 was, this was Investors Chronicle from 2 weeks ago, and then the markets have gone higher since that. It was reading 39, and it said the only two times in history that has been over 30 were the 1929 crash and the dot-com boom just before it crashed. And you think, that don't sound too good.
It doesn't sound too good, Pete, and I'm not sure people want to end the year with that sort of cheer.
Yeah,
from you. But you need to point these things out, Pete. When you see these things, the whole point of the podcast is trying to alert people, and for them to then go away, do their own research and their own thinking.
Their own planning.
Each individual has to make their own mind up as to what they're going to do, what risk are they going to take regarding their own hard-earned money. And all we're here to do is just have a chat about stuff. And if you pick up some good ideas and you pick up some things that trigger your thinking to go away and do some research, then we've done our job. We're not here to tell you exactly what to do with your portfolio. We're not financial advisors here, Yeah,
well, nobody knows, do they? I mean, all I can say is that my personal view is, and the way I'll be, my sort of roadmap for what I think is going to happen is that I am looking pretty much as I said. I think January, most of February will be all right. Then I think March will come, and I think March will see a dip. Whether it will be a big, I don't think it's going to be a big spanking, but I think we will get a sizable dip, maybe 10% or something. And I think it will be pretty scary because, we're so used to markets being sort of quite easy in a way.
Yeah, it's going to be very, very interesting, Pete. It's going to be very interesting.
That tech index is, the NASDAQ it just looks so overvalued to me.
We say it's overvalued, but a lot of people have been saying that for the last 3 years, mate. And Apple just keeps climbing. Amazon's had a bit of a pause. Microsoft keeps climbing. So who knows? And you know what? Over the next 3 years, we'll be talking about a whole different swathe of tech stocks that we weren't talking about before because they're going to come out.
Yeah.
So Pete, what were your winners and stocks that you were like, I'm disappointed regarding those ones?
That's an interesting question, actually. I wish I'd sort of been more prepared for it. Anyway, on that, one that sort of frustrated the hell out of me is Air Partner, AIR, because it's sort of been all right, but it hasn't really done much. And that one just strikes me that it should have done more. What other ones really?
Why do you think it didn't do so well though, Pete? I mean, obviously, if it's Air Partners, I'm thinking it's air transport, COVID, supply chain problems, blah 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 blah. What triggered it?
Well, when you actually read the results and that, it's been doing pretty darn well, and as a business, and it's got a strong balance sheet with cash, and it's on a pretty low rating and a nice dividend, and you just it's sort of stuck in a sideways range. I think from memory, I just looked quickly on the chart. It looks like, it's sort of around just, I don't know, something like £1, 2 pence or £1, 4 pence or something. It seems to get up to £1, 4 pence and it drops back, and it never seems to be able to get above that. So, but I just think that's one that, I'm patient, I'll hold it, I'll be all right, but it's sort of been a bit disappointing, really. What other ones? I mean, there's been ones that have done really well, like pets at home. That
you called that brilliantly.
Surprised everyone.
You called that back in the dip of March, April, May of 2020, mate. And you spoke to me about it, and I went, nah, I can't see it, and I got that completely wrong.
Well, mate, at this point in time, I need to just do a quick comment that I know Jason from Milton Keynes. What is he? ABB. Something on Twitter, yeah, Apple Bottom Beans on Twitter, right? I know he'll like this. I was listening to something the other day, and someone said they've got a sausage dog, and the sausage dog's name is Biggie Smalls, the notorious DOG. I thought that was ace. So I know Jason would appreciate that, and I know there's a lot of dog lovers who listen to our podcast.
Jace just comes on, and most of the time I see his tweets, and he's just another joke. He's just a comedian, mate. I think he should be on the stage, to be fair.
He's a good lad.
He's a good lad.
I'll tell you what, SOMERO, should have done well, and it has, which is the sort I like, Yeah.
So have you held that for a while, Pete, that one?
Yeah, ages, man. Ages. And I keep picking up lovely dividends and special dividends, so I've been well happy with that.
Well done with that one then, mate.
the banks have been disappointed. I've got Standard Chartered and HSBA, which we talked about on another podcast.
We did talk about that, and you said you were going to get rid of one of them. You said you were going to get rid
Well,
of Stan.
still
You changed your
thinking,
mind.
mate. I haven't figured it out. It's
Oh
been
dear.
crazy. Water Intelligence, WATR, has been absolutely nuts for me. It's been so good. PYPL has been a pain in the backside, but I don't feel a great urge to sell PYPL. PayPal. It's been a pain, but I still think there's a hell of a good platform there, and payments platform businesses are generally good news.
Yeah, let's go back a bit though, Pete. I want to talk
Yeah,
about SOMERO there. You touched on SOMERO. Just brought it
yeah,
up here now.
yeah.
Year to date, it's up 77%. I'm not sure whether
Wow.
that's plus or minus dividends, but it's done phenomenally well, and it's sitting near multi-year highs. So
Yeah.
what's your thinking there? Are you going to because you very rarely sell anything, so are you just going to
Well,
ride that wave?
yeah. Do you know what? It's a company that I've held it for quite a long time. I feel like I know it pretty well, if you see what I mean. It's the market. It's got something like 95% market share, so it absolutely dominates its market. It's had problems in the past where it's been very susceptible to weather, because they make machines that people use to lay flat floors for storage facilities and
Yeah.
things. Yeah. So it's been very susceptible to the weather. But I think as time's gone on, that sort of cyclicality seems to have come out of it a bit. And I think it's because it's got new products and things as well. There's a lot of interest in new products coming along. I'm just looking on SharePad now. It's on a forecast PE of 12.5, 2-year forecast PE of 11.6, and it's got a forecast yield of 5% and a forecast 2-year yield of 5.4%. And it's got something like 30 million cash. So, I just sort of think, well, why would I want to sell a stock that dominates its market? It's got loads of great new products coming on, decent management team, potential takeover opportunity, not a bad rating. Okay, you've got to allow for the fact it's cyclical, so maybe that will limit it to sort of 14, 15 at the most. But you're picking up 5% dividend. I mean, what's not to like, sort of thing. And the chart has momentum,
No, I have to agree with you, mate. If you've got something that's doing well, then unless you've got some reasons to find, I think you should look for reasons to try and trim and sell. Sometimes when things have done exceptionally well, but if you can't find the reasons to do that, then why not carry on running it?
I think you've hit a good point now. I think it will come a point where I'm going to have to start thinking about top slicing a bit, because I will start to think, oh, blimey, I've got a lot in this one, But you look at things like, the infrastructure bill and stuff in America, because they've got massive exposure to America. If anything, they're overexposed in America. I wish they could achieve more in their overseas markets. I mean, they're doing stuff overseas, but it never seems to really reduce that sort of US exposure.
Yeah, I think that's a fair point there, mate. Fair point.
But if they ever did get traction in the sort of non-US markets, that would be another good thing for the stock. So
yeah, like you say, the opportunities, Pete, like you say, if it's holding that size of the market and it's starting to grow, the market expands. So if they're having 90% of a 10%, 15%, 30% bigger market, then the revenues are going to just fall to the bottom line, aren't they?
yeah, exactly. And that's the thing. It's so cash generative, and it quite often pays a special dividend. So when I say 5% dividend or whatever it is that SharePad's predicting, there could be special dividends on top, and they've been doing share buybacks as well. So I mean, it's just a cash beast, really.
Yeah, I mean, this is the stock I think I ridiculed probably a couple of years back, because it used to always have a profit warning when it rained. Is that the same one I'm thinking of, Pete?
Exactly, it's what I said earlier.
Right.
It really weathered about. I guess what might have changed is that supply chains and logistics storage has become more of a thing since those days.
Right.
You think that the big part of their business is laying flat, continuous floors with no joins in them, so that the robots that are picking shelves and stuff can just glide along and not stop every time it comes to a junction in the concrete. And so I guess that's played into their hands, really.
Absolutely. I mean, it wouldn't have taken much to devise a way to be able to cover the actual area that you're laying the floor, but yeah, high tech.
I mean, it sounds ridiculous, doesn't it? Because you sort of think, well, that can't be that difficult, but actually, if you think about it, it is.
Yeah, of course,
the big problem you've got is that when a concrete lorry turns up without concrete on it, you've got to lay that damn stuff quick because it goes off and it goes hard, and that's so it's I think where they stand out is they've got incredibly good support and service for the people who use their machines.
Cool. Okay, mate. Do you want to add anything else?
Well, no. I mean that
I mean about any other part of your portfolio or any other stocks.
No, I mean I think that sort of covers it. I think generally speaking, this year, I think I've certainly not overtraded. If anything, I've undertraded. I think that it's something we discussed on the podcast probably two or three podcasts ago, when I said maybe what I should do is when a stock has a profit warning, I just sell it. The first profit warning, dump it. That's the only sort of big fundamental change that I keep having in my mind. But then I'm achieving reasonable results without doing that. So I thought, well, what's the point really? It's a difficult one. I think if you're sticking to quality stocks, then avoiding the speculative stuff that's all a bit dreamland, then really quite often they can take a profit warning. Yes, they'll be in the doghouse for a year or so, but they come back nicely, and there's an opportunity to buy more of them, and then you make more of them when they run up the next time. So I'm sort of fairly open-minded about it, really.
No, I think that's a good point you've made there. I mean, maybe you've answered most of this already, but I'll ask you it anyway. Is that what would you do differently, Pete?
Well, I think the big difference this year will be that when I come to hedging, I'm going to use the FTSE 250. That's going to be a big change. I think the other thing that I've done well this year, but I must make sure I continue to do, is I will be very slow and thoughtful and do a lot of research and analysis before I buy a stock. I want to be really sure when I'm buying a stock, I've got to be buying it for the right reasons, and it's got to be good. I think I've done pretty well at that this year. I think that's probably something I've done well, and I'd like to keep that focus on making sure I'm buying quality.
Cool. No, thanks for that, mate. That's been really, really informative.
And at a reasonable price. It's that classic thing, valuation. I keep saying it. If people had more valuation discipline, it would have kept them out of a lot of the stuff that's kicked their ass this year.
Yeah, absolutely. I mean, that we're talking about quality at a reasonable price there, QORP, and GARP, growth at a reasonable price. So it's very, very important.
This is a quick hello to you, our valued TwinPetes Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe, and you'll always be the first to get the new episodes. Thank you for your continued support.
Okay, Pete, we're going to take a quick break here and talk about the Twin Petes challenge. We're recording this on the 29th. We've got until the 31st, and a couple of days before we hit the new year. And this is going to come to a close for this particular 12-month run. Or I think we actually started it back in February, March, actually, Pete, when we actually triggered it properly.
Yeah.
I want to thank everybody of all of our businesses that got involved, our partners that got involved, our sponsors that got involved in this, and all of the Twin Petes family that got involved. You guys, ladies, gents, have been absolutely phenomenal in supporting this particular challenge that we've got and will continue to run up until the first week of January, effectively. So please, if you've not donated yet, please consider making a donation. If you've been lucky and the Santa arrived to your portfolio, if you've enjoyed more than one of these podcasts, please try and donate a little bit of money to these disabled children that are in need and disadvantaged in our community. We're sitting, ladies and gents, at a total at the moment today at £20,000, £151.
Oh, brilliant.
So that's absolutely amazing. We can still do a bit more over the next couple of days. That'd be phenomenal. If you've got an opportunity to make a donation, please do so. Our last donation was 5 days ago from Sanjay Korea. So thank you, Sanjay. Sanjay said, thank you for all you do for investors that want to learn and progress. Your podcast is pretty good too. Smiley face. Sanjay donated £100 and gift aided to us. Terry made his donation again, and once again I'll remind people that I'm going to match that when we finished for the year. Northy donated £50 plus £12.50 gift aid. Enjoying the podcast as ever. How about a notional fund for 2022 with suggestions from your loyal listeners, and you guys can filter for selection just for fun. It's an idea. £50 plus £12 gift aid. We'll have a chat about that later on, Pete, shall we?
Yeah.
Elric, our absolute legend at Lemming Investor, has been collecting his subscriptions for his own particular websites that he has, and he's made a donation again from his small company Champion company, and he writes, I have enjoyed playing a bit part in helping Twin Petes Challenge for this worthy charity. Happy Christmas. From Elric of the Small Company Champion, and Elric donated £289 plus 72 gift aid. I think Elric's probably donated about £1,500. If I'm honest, I'll have to tot it up, but he's been absolutely phenomenal, and I'll be looking after Elric when I see him, whether it be in Leicestershire or up in Manchester at some point in 2022. I'll make sure he's looked after. Mike Wright, thanks for the podcasts, Peter and Pete, wishing you both health and happiness over the Christmas season. Here's hoping you can get Memphis past the 20k mark soon. That was £20 plus £5 gift aid, and that was
thanks, Mike.
Donated 7 days ago. Kerry, thank you for the podcast. £30 plus £7 gift aid. Thank you, Kerry. Tony Reed, great work. £30 plus £7.50 gift aid. Francis with an E, that's FRANCES on Twitter, £68. Thank you so much, Francis. That's so very kind of you. Elizabeth,
thanks, man.
You're so close to the 20k, guys. I have my fingers crossed you'll do it. Thanks again for all insight, info, and entertainment. Love it. Smiley face. £20 plus gift aid. We also had our great friend Diana at Diana E Patterson on Twitter. 10 days ago. Thank you, Twin Petes, for your educational, entertaining podcasts. I look forward to them every fortnight and also enjoy listening to your brilliant guests. Merry Christmas to you both and Memphis. £100 plus gift aid of £25. Thank you, Diana. That's fantastic of you.
Thanks, Di. That's brilliant. I hope you're well.
And that brings us up to date. That took us over the 20k. So you guys, ladies, gents, have been absolutely fantastic. So let's see what we can do in the last few days. If you've done well, drop us a little donation on the Just Giving page, which is www.justgiving.com/fundraising/Twin Petes. And you guys have a fantastic last few days of the markets and a fantastic new year. And to all our listeners, thank you ever so much for your donations. We really, really appreciate it. And it will go a long way to making a lot of young people happy at the Memphis Hub. We're going to buy a piece of kit for that particular charity, and I'll let you know when that's been sorted out in January, February time. So thanks ever so much again for all your donations.
Brilliant.
Pete?
Yeah.
Are you still there, mate?
I'm here, mate.
Okay, what do you think of that then, mate? We've actually did it. We actually smashed it.
I said this on Twitter the other day. It's just so great that something that me and you do is a bit of a giggle in terms of me and you recording it and whatever. And the fact that a lot of our listeners and that seem to like it. But the fact we're I think everybody who's contributed, and even the listeners who haven't contributed, but because I know that people do things their own charities and whatever. I think people should feel good that they're part. We've actually done something good and decent, as opposed to just shuffling blinking numbers around on a screen all day and doing something that's socially probably completely useless.
Yeah, I mean, this is the thing, Pete. We recognise that everyone's got charities they support. Some people got a multitude of charities that they support. So we appreciate that not everyone can. We appreciate also that some people simply haven't got the spare money to actually make the donations as well. But for the ones that have made multiple, that have ones that have done, like at Lemming Investor has donated, over 1,500 quid.
Just
maybe.
incredible.
At some
Thank
stage.
you, Alric.
Alex Schlick, ShareScope that have donated, London South East that have donated, Poolbeg, Open Orphan, that have made significant donations because we myself and Lemming Investor put on the event in Leicester, made significant donations. So that's the reason why we're over 20k. We've all done this together. So that's what I appreciate. This is about kindness and inclusion and thinking about people that are disadvantaged in the community. We've got lots of people that are saying they're ISA millionaires on Twitter. You know what I mean? And lots of people that are saying they're up 20, 30, 40, 50%. They're probably making donations elsewhere. But if you haven't made a donation, please, please, please do so. We had DM Keen that came out of nowhere and donated 3,750 quid. I will always be fantastically grateful for that individual. And as and when they want to say it was me, I will take that person out and make sure they're looked after. You know what I mean? Because that's what it's about. My stuff is about doing things unconditionally. The reason why this podcast is put together in the way it's put together is because I want this to be about education. It's not about Pete tipping his own stocks. It's not about me ramping my own stocks. It's about education. It's about people being able to take it away and do stuff with it and learn and research and find their own way, which no one else can copycat. No one can copycat what Pete's doing. No one can copycat what I'm doing. No one can copycat what Warren Buffett or Charlie Munger are doing. You have to find your own way.
Yeah,
and that's what we're trying to do. To encourage
we're
you
nearly
to
as
learn
old
more.
as them.
You always have to put that in there, mate, don't you? Right. So, Pete, we asked the question as well, and I'm going to talk about some of my stuff in a minute. But we asked the question. You put it out really, really succinctly on a tweet. We're hoping to record Twin Petes 65 this week, and Conquers and Moi will cover mistakes we made this year, what we can do better. If you have thoughts yourself on where you will focus improvements, please tweet us and CC both and talk about the best ones. So I want to start with Claudio, Pete. Claudio H. Fox. That's been instrumental in my learning and improving my mining and I stopped making donations this year to the mining side of things and actually made some money for once. And he came up with to improve: no impulse buying, stick to what I know and understand. Being knowledgeable in the narrow field can produce good returns. Detailed research. Best work is done away from the screens and interference. Emotional intelligence. People are dots. Connect globally and share information. Areas to improve continued here. Knowing when to switch off. Have fun. Further extend my TA. Listen better. Give more back. Read across investing. Meet more people in person. Engage more in second languages as a matter of courtesy. Site visits, meeting leadership, triangulate more. And then he's finished. Just think about it. Twinkle, twinkle, little star.
Wow.
So that was a really good one, Pete. What do you think of some of those that's been shared there by Claudia?
Well, I mean, that's quite a list. The one that really sort of hit me, and it's the cliche one, really. It's become a cliche, but it's so true. And that is, that cut out the noise. It's so important. You've got to get away from the sort of the hubbub and the buzz and the constant noise of markets and the noise of Twitter and the noise of bulletin boards and God knows what else. And, and to sort of take yourself away from it and get downtime and be able to focus and to learn. The other thing he said was getting a narrow focus on something, which is very much that Zulu principle idea. The book by Jim Slater, isn't it?
Yeah.
He wrote the book, The Zulu Principle, and that was the idea that he got the idea from his wife, where his wife had become like a bit of an expert on the Zulu nation, and only because she'd sort of put loads of effort into learning about the Zulu. She knew nothing else about anything else, but she knew about the Zulu nation because she'd sort of focused her learning, her mind, her research on this one topic, and that was sort of the point of it. But, there's a lot of sense to that.
It's that idea of drilling down and specialising, I think a lot of us, I've done it a lot in the past. I do it less so now. It's sort of a scattergun approach. It's like every stock looks like a great stock, but we haven't really drilled down to specialise in an area. And I think once we do that and we improve in a certain area. For Claudio, it's the mining sector, lithium space, etc. But he's expanding his reach now into uranium. You know, he's expanding his reach into copper, gold, and other stuff. And he wants to learn more. And he's so, you know, I talk about doing 100 hours and 120 hours and so on and so forth. He exceeds that, Pete. You know what I mean? And he'll do the similar to me at times. He'll do that 100 hours of research and he'll go, nah, that's not for me. And he'll move on. Because he wants the best of the best of the best. He wants the quality stocks that's going to, over 3 or 5 or 10 years, it's going to make him a portfolio changer. That's what he's after. He's not after a stock that he's going to get rid of in 3 weeks or 4 weeks' time because it's gone up 10 or 20%. He wants to, or hopefully find a stock that will do really, really well for him. So that's what that's about, specialising.
I guess something just to put into the flip side to that, and I think it's something we've covered a bit here before, that one of the dangers of overlearning something, and I'm talking really in specific to a particular stock, is that if you sort of overlearn things about a stock, it increases your emotional attachment, which in some ways is a good thing because it's good to run and to stick with your good stocks. But sometimes that can become a bad thing because when there is, you know, bad news about the stock, you don't react to it when perhaps you should, because you're so in love with this company, because you've so increased your emotional attachment by reading so much about it, you know.
Yeah, there is a little bit of there is some truth in that, Pete. There is the anchoring effect where you load yourself down with so much information that even when you see bad news regarding the stock or you see things slightly changing, you're determined not to come out of it. You're not going to be shaken out of it because you love the stock so much.
Yeah.
And you know, I would say I'm probably in that category regarding AZN. Holding it since 1994. I've seen all the peaks, the troughs, and everything regarding that particular stock. And I'm still, you know, some people would say wedded to that, and it might be a mistake. It might prove to be a mistake at some stage. Who knows?
No, so it's a balance, isn't it? Sometimes it's a good thing, you know.
Yeah, I mean, the people that have held on and done well with Tesla will say it's not a mistake to overlearn about Tesla, Microsoft, or Apple. They've done extremely well about in that stock when other people have derided those stocks many times and still do. You know, and
perhaps their next bit of learning should be about valuations.
Absolutely. Right, I'm going to move on now to at Faisal. That's at FEI5AL, and he wrote, "Thank you for the feedback as well, Faisal, and thank you for your support all year round as well for this podcast. As for mistakes, on my part, I have loads of areas to improve." Love the honesty there. One of the biggest is to understand that 2020 was a once-in-a-decade opportunity. If I can hold on to my diminished profits and add to them in 2022, then I am on the right path. But the route and rules are always changing.
So I'm just taking my jumper off, so I sort of like only just heard it, but no, I think there's a lot of sense to that. I think it's an interesting point that 2020 was a weird year. And I think the start of 2021 was a bit weird because let's be honest, the start of, you know, the first 6 months of 2021, you couldn't go wrong really. After
the flux. But the thing was, Pete, we didn't know we were going to get that that wasn't in the V shape, was it? It was like a narrow recovery. It just went whoosh, whoosh and back up again. But no one saw that coming, Pete.
Absolutely.
You know, so we can look back in hindsight and say that was an opportunity. But I think, you know, lots of people didn't come back in the market.
No, that's right. And obviously for myself, my hedging strategy worked out a treat there because using the hedging, I was able to make money on the way down on the shorts. And then once it started to turn, I made a bit of a false start. I think I closed my short and banked a lovely profit to offset a lot of the losses on the longs. Then I opened another short a little bit later, and I ended up closing that one for a small hit. But then I just let it run then. So I was very quickly back into 100% long. So it actually worked out quite well for me.
Okie dokie. Cool. We've got Ben Sharman at Ben Sharman.
Hi, Ben.
And Ben wrote, "Do not buy after a profit warning. I bought AVON after their first one, and they subsequently warned again. Do more independent research and do not copy others into buying and selling stocks just because they are very bullish or very bearish. That's something we've been repeating forever on this podcast. Don't follow other people. And with profit warnings, as historically the reference, the research has always said, they tend to come in threes. And AVON, I think it's probably past 3 now.
Yeah, that's exactly it. I mean, profit warnings often come in threes. The other thing that you've got to look for is when a stock has got itself into trouble, as AVON has, and got itself in a bit of a mess, usually that situation changes after a long period of going sideways, and I'm talking like it can be a year or something, and usually you need the old management to get kicked out and you need new management to come in. Usually when the management changes, that's the first sign that things are going to improve.
Well, the irony with this one, Pete, is that the old management left AVON and the new CEO came from the milk business, and you've got a milk business leader becoming a CEO of a defence company, and since then the other profit warnings have been triggered by the CEO being in a job which has imploded on him, because he's used to dealing with the milk side of business, and that's why AVON is where it's at right now. And I suspect that 2022 could be another difficult year for them.
Yeah, it sounds like it could be a difficult year for him as well.
Absolutely, it could be a difficult year for him. Our good friend Steve Holsworth at S Holsworth 1963, and Steve writes, for me, I need to be more disciplined in the time I spend reading, listening to investment websites and podcasts. Twin Petes is a must, of course, as are Paul and Jack's SCVRs and the Share Profits Bearcast, as they provide different views but should wean yourself off some others. Thoughts, Pete?
Yeah, I mean, all good stuff. I mean, the SCVR stuff's good with Paul Scott and who's the other guy who's on it?
Jack Brumby, I believe it is.
Jack Brumby, yeah, no, that's right. Yeah, no, I mean that'd be good stuff. Jack's a good lad. Yeah, so that's cool. And Share Profits, I mean, I imagine it's quite entertaining with Tom Winifred. Yeah, no, it's good advice there. It's do your research and all the rest of it, isn't it?
Yeah, okay. Our good friend Scrumpy 222. Hi, Scrumpy, good lad. How are you?
Scrumps.
Went well. Improved research, finding companies, especially FTSE 250, based on own research. Well done. Went wrong. Not slicing shares. 888 and ENT both reached highs a few months ago. Never sliced. Excusable in my mind for ENT. Potential a bidding war. Not yet in brackets. 888 news not due until next year. Easy to say with hindsight. Psychology. It is greed to hold when logic suggests maybe a competing bid, ? If long-term hold, should I worry? I never sliced and bought more when lower price, ? We keep talking about psychology, and I need to stress this regarding psychology. When I talk about psychology, a lot of it's about emotional psychology, because the market is pushing us and pulling us and pushing us and pushing us and pulling us all the time, wanting us to do something. And sometimes doing nothing is fine, but other times it's actually asking you to fight or to flight regarding the circumstances of a stock. And sometimes, like you've said in the past, Pete, you've had a takeover happen, and you've held on and held on and held on and held on. I've done the same, because you're thinking, oh, it's a competing bid. When we love a takeover battle, because we see the price going up and up and up as both teams of competing bidders don't want to give in. So the price does well. Yeah. But sometimes, either one of them walks away and the share price drops, or the company itself says, you know what, we don't care if there's two people bidding for us. We're not selling. The share price capitulates anyway. Yeah, it's a difficult one. I mean, my general policy with takeovers is let the first bid come in. I mean, I've got one now with CLINIGEN, CLIN. Let the first bid come in. Give it a few weeks for it. If there's going to be another bid, it will come within sort of like 6-7 weeks, whatever. If there's no sign of it, after a while, I get bored with it and I'll move on, But I usually give them a little bit of space, because it really is very upsetting when you've had a takeover offer, you sell early, and then not long after more bids come in and damn thing keeps going up. And I'll tell you what, that psychologically is a horrible feeling. It is. But I think one of the things that happens as well, though, Pete, is that we learn really. Again, we learn more. I've learned far more. I know you have, from the mistakes we made, and that's what's coming out here. This learning curve that we have because of the errors, some of the errors that we made, are going to make some of us, hopefully most of us, improved and better investors going forward into 2022 and beyond. Okay, we've got at good to be heard. That's at GUD2 be heard.
Hi mate, he's a good lad. He's a good chap.
Yeah. What went well? Number one, improved organised working environment conducive to research and focused, coupled with a new MacBook. Well done, you.
Whoa.
Which improved stability and portability. 2, share scope. Previously with Stocko, but share scope supported my personal needs for easier research. Well, there you go.
Excellent.
Yeah, and you got a MacBook out of it as well. Brilliant. Right, we've got one of our
mate, that's an interesting one. Let me just say something on that. I like that thing about working environment. I think that's a really good point. It's this classic thing, isn't it, that people think, oh, traders, they got millions of screens in their house and whatever. It's like, I've got like just a laptop and a couple of tablets and a phone. You just don't need all this paraphernalia. And I think, having an organised desk and all these kind of things and working in an organised way is really important and really helpful. And I think it comes back to this thing about being robotic with how you work, do things in a controlled robotic way. And it's like, if the markets are up 3% on the day and you're really happy, be robotic about it. Don't get overexcited. Don't get over exuberant. Don't open up bottles of champagne because you've had a good day, And equally, when the markets crash 8%, don't go hurting yourself and stuff and wishing it was the end of the world, Just stay robotic, stay calm, think, right, what do I need to do to, how could I have avoided this mess in the first place? And think, what can I do now to improve the situation going forward, whatever.
No, that's a very, very good point, mate. I think it's that thing for me is about staying calm, regardless. So when things are going well, staying calm. When things are going badly, staying calm. And for me, some people might mock it, but meditation helps. Staying calm helps. Practicing NLP helps.
Whatever works.
Going for walks and just being among greenery and away from the phone and the screen and the noise helps.
Yeah.
Anything that will improve your life, never mind the investing. The life and health is more important than investing, to be fair.
Your mental calmness, isn't it?
So anything that improves that is a bonus for me. Okay, so we've got one of our young listeners here and new investor at Josh Tom 93. That's JOSHTHOM 93.
Hi, Josh.
And he writes, sounds very basic, but I'll make sure to stop investing with emotion. With mobile apps, it's very easy to buy, sell stocks on impulse. Moving forward, I'll make sure to stick to investing rules that I'm building/refining and only execute on a PC. Slowing impulsiveness, that's a good point. Also reducing positions in highly speculative stocks to hold higher quality businesses with less volatility. This year has taught me that diversity and stability helps no end to the psychology of investing. Message on diversification amplified in some of your recent podcasts.
I mean, that's just
sorry, just one more, Pete.
Yeah.
Final one being every CEO and investor wants to showcase companies and holdings in a good light. This is fine, but in 2022, far more importance will be placed on personal analysis. Podcasts /brokers notes will be sparks of inspiration for further research.
I mean, it's just great. I mean, the fact that the recognition that high risk speculative stocks are going to mean pain, having quality is really important. Not getting overweighed by the opinions of others, having your own thoughts. It's all great. Having rules. I love that idea of having rules. That really helps.
There's two things there, which goes back to what you were saying before, and you've repeated numerous times, Pete, about how slow you are to make decisions. And Josh is stressing there about trying to avoid making an impulse decision. He's touched on a really good point there. We talked about it before with the Robinhood Reddit sort of crowd, right? We've got a mobile supercomputer in our pockets all the time, Pete. Even when people are working at work, not working from home, that notification's going beep, 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 and you go, oh no, what's happened to my portfolio? You're looking at, you're going to the toilets, you're going for lunch, you're going to the theatre, you're checking on your portfolio, and it's forcing you to make decisions. Sometimes you go, you know what, I'm going to switch my phone off today. I'm not going to look at what happened to my portfolio. The less we look at the portfolios, the more that the portfolio actually looks after itself, you know?
Yeah, totally. Yeah. We had this conversation before the podcast, before we started recording the podcast. We were sort of talking about how this time of year, these sort of days around Christmas and New Year are actually really nice, because even though the market's open, you know, there's nothing much you can do about it. It sort of isn't particularly interesting. And, you know, I haven't hardly looked at my portfolio all day. I probably looked about 3 or 4 times. Whereas a normal day, I'm probably looking at my phone 15 times in a day, you know. I just haven't felt any interest or any need to. And you don't need to keep looking at it.
No, that's a good point. We've got our good friend again here, mate, at Child of the 70s.
Oh, yeah. Neil.
At Child of the 70s, literally, that's his Twitter handle. What went well? Leaving my finger off the buy/sell button and building up my cash pot through dividend accumulation for further purchases. What to work on? The constant feeling that I have to do something with my portfolio and the cash is just building up. That's a brilliant point. Well made there by him.
I love that dividends one. I mean, it's so important. Again, so many investors buy stocks that don't have dividends. Straight away, they're hampering their performance by 3-4% a year. They're giving away 3-4% of annual portfolio gain by not taking dividends. Why would you do it? Madness.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a TwinPetes Investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special TwinPetes offer is available to new subscribers only, and you can subscribe using the promo code TwinPetes. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the TwinPetes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
I think it's difficult, Pete. I think it's difficult because we've all got to have the portfolio that we want to have, right?
Yeah.
I've got plenty of stuff in my portfolio that's not dividend paying. And the beauty of that is that I'm looking for the actual capital gains on that particular stock.
Yeah.
Will it compound better than the ones without dividend? Depends on what that stock is and what field it's in and what niche it's in and how good the actual management are, you know, and how quick they are to generating revenue. So it's not of one or the other or whatever. I think having a combination in your portfolio is great for diversification.
Oh, totally. Yeah, totally.
So go on.
I think, put it another way, right? I think for very good, very experienced investors, speculative stuff can work really well, but you've got to be a particular kind of investor to do well at it. And I think for a normal, everyday, average person, male or female, have I got the right words there? I think.
Stop. Just crack on. Come on.
Yeah, I think for the sort of normal person, I think they've got much more chance of doing okay by buying quality stocks and reinvesting their dividends and doing the basic stuff right.
I think that's wise words there, Pete. I think and I wouldn't use the word normal person. I think for somebody who's new to investing and wants to have a conservative portfolio, having a dividend paying stock or fund that's a dividend hero that's been paying dividends consistently, consecutively increasing. That's a sure way to be able to compound your portfolio over the long term and lowering the risk. We've got some fantastic investors out there. I'm going to give a shout out, as it's towards the end of the year, to Mike Ridyard at Ridyard Mike, who has done exceptionally well this year. And his main bulk of his portfolio are dividend paying stocks. But he's actually quite an aggressive trader, momentum trader of his portfolio, and he'll stop slice and he'll go back in and buy again, and and so on and so forth. And he's on the way, if not already there, at achieving 20% this year, Pete. And most of his stocks, are dividend-paying REITs, dividend-paying funds, and he's done it exceptionally well this year. Another person that's done high-risk investing, who's done exceptionally well, is that Battle Bus 141. I think he's on the verge of hitting 50% this year, but he's taken extremely big risks in small, illiquid stocks. But he's done the research on these stocks, Pete. And can he repeat it next year? I don't know. But 2 or 3 years ago, he was getting lampooned because, the vast majority of his portfolio was getting profit warning after profit warning after profit warning. And he shook himself up and he shaked himself down and he said, right, I'm going to refine and get better. I'm going to refine and get better. I'm going to learn some stuff. And here he is this year. And he's probably one of the best performing investors that I know on the FinTwit and Twitterati. The thing that saddens me about his portfolio performance is the people now that are coming out trying to undermine him, and trying to say, and are actually jealous and envious of his performance. They weren't there when he wasn't doing well. They weren't there saying, how can we help? I think we should be happy for anybody that does well. Investing is so hard, Pete. Trading and buying small cap is really, really difficult. You ask anybody, you spoke about people being out there now, minus 10, 20, 30, 40%. How many of those are going to come out and say, I'm down 10, 20, 30, 40% in their up-to-date blogs, at the end of the year? I don't think there's going to be that many. When he was down 20, 30, 40%, he was talking about it openly on a regular basis. So when he's done well, we should be applauding him. When anyone's done well on investing, you should be applauding them. Don't let envy and jealousy override what is happening out there when someone's doing well. Because when you're doing well, you will want to be applauded. You will want other people to say well done. And that's what we should be doing in the community. We should be helping people rise, not trying to undermine and hoping people fail.
Well, the thing is, when people have done well, the thing to do is try and understand how they've done well and see where you may tweak your own approach to copy some, not copy, but to replicate some of those methods or whatever, where it's suitable. Maybe that Battle Bus's approach is too high risk for you, fine. But there might be bits where you think, well, actually, I can do similar to that, and that's the way I'm going to go,
Absolutely agree, mate. So, lessons to learn. This is from Raj at RamRaj35 Otmaya1. Okay.
Hi, Raj.
We know Raj. We've seen Raj around and about. Lessons to learn. Take out emotions. Again, psychology again. And don't have favourite holdings. Have a disciplined approach. Don't catch falling. This sounds like a chat that I had with Raj on numerous times, by the way. So it sounds like he's repeating what I've told him, but it's good that he's learning.
He's reading it off something you wrote to him.
Yeah. Many talks. Too many talks, probably. Don't catch falling knives. When wrong, don't dwell and move on. Stay humble. Have an open mind. Don't get too excited. Stay calm in a storm by cutting out noise. What else we've got? So that's what essentially that he wrote, and he's absolutely spot on. But I think the thing is, being disciplined is so hard, Pete. Because every time we see a stock going down, we think, oh, that was at £4 and now it's at £1.50. Let's go and buy it. X, Y, and Z is talking about that stock and it's 52-week lows. It must be a bargain now, and it falls lower.
It's not very exciting, is it? Being disciplined. It's not exciting. Pretty dull and boring. So I think that's why people aren't very good at it.
Yeah, but you know what? It's so expensive catching falling knives, mate. I've got the scars. I've got the T-shirt. Boy, oh boy, have I been knifed so many times. And that's not just by the trolls and the people that are sending out vitriol, Pete. But it's hard, mate. It's tough. Investing is tough.
It's back to that patience thing, isn't it? It's like patience and discipline go hand in hand.
Yeah.
To have discipline, you've got to be patient and calm and whatever. You've got that email from Kevin, haven't you?
I have. You've good of you to remind me. So this is from. This is from Kevin. What's his Twitter handle, Pete? Do you know it?
Kevin S on Twitter. I think it's Kevin Sayers, I think.
Okay, so
we had a long... said that. Sorry, Kevin.
We had a long email from Kevin. We're just going to cut down to the bottom, and he's finished at the bottom by saying, all of this has made sense. I guess I will sum up my learnings up as follows. and this goes against you, Pete, mate. Don't use leverage, which is a good one. I agree with him entirely there. Don't follow the crowd with a FOMO, fear of missing out. Do in-depth research. Don't follow others. Or if you do, make sure you do your own thorough research. Ensure your balance risk and reward at a level you are comfortable with. Remember, you are in this as a long-term investor, not a trader. Others might not be as I appreciate. I'm not sure what that sentence says there.
I think what that means is that you know, some people are traders on Twitter, some people are long-term investors, and if you get confused between the two, if you follow someone into an idea thinking it's a long-term investment, but that person's actually a short-term trader, you might find that they're just trading it for a few pence and then they're out, whereas you're left with a baby.
Which is what we've said numerous times. Yeah, absolutely spot on. Well done. Well said. If you invest in AIM stocks, look at market cap and volatility linked to the risk point above. Use investment trust to cover specialist areas, e.g. mining stocks. Don't be afraid to ask for advice. Following Jace's appearance on the show and tapping into I'll Get You Gadgets knowledge, I bought Stan Weinstein's book, and now looking at my entry points much more closely. I haven't 100% implemented this, but I feel this will be a major step change in my approach. I've caught too many falling knives in the past and now look to time my entry at a point where the SP has a greater chance of rising. I may miss out on the initial climb, but it's a safer place to do so. Oh, that's such a fantastically great point. Finally, thanks to you and Conkers, your excellent fortnightly podcast always has some words of wisdom and is a great 90 minutes of my time well spent. All the best. Wish you a fruitful 2022. Happy New Year, Kevin.
Brilliant. Yeah, no, I mean, Kevin's bang on now. I mean, there's so many great points. I'm trying to think the ones that sort of stand out. I mean, it's just
FOMO, Pete. FOMO. I think this is the thing. I think the big thing about the momentum stocks that were doing exceptionally well at the beginning of the year is that, and I'll keep saying this, you know, it ended up being a cluster. Lots of other people got involved in the stocks that were going up. It's going up, so I'm getting involved. Going up, so I'm getting involved. It's gone even higher, I'm getting involved. It's going up, so I'm getting involved. So everybody that got caught up in FOMO bought near the top or bought near the mid, and then they got 20%, 30%, but they thought it was going to go even higher. And then those stocks rolled over. You know, many stocks rolled over.
It's funny because I remember us having this conversation, and we did it on the podcast, I'm sure, and I've certainly mentioned it on Twitter, and I'm sure it's a thing. We were sort of saying how, you know, valuations got very detached from reality early in the year. There were loads of stocks on forward PEs in the 40s and 50s. But it's interesting, a lot of that, I mean, still in America, it's still like that, but here in the UK, a lot of those extreme valuations have come right back. And it just goes to show that when things get overvalued to high extremes, that isn't the situation that's going to last. It never does.
It never does, Pete. It never does.
And again, using valuation discipline would have kept people out of a lot of these FOMO situations where they got sucked in.
Yeah, absolutely agree. Right, we're 75 minutes in, Pete. I think what I'll do is I'll touch on some of my learnings, yeah, and I'll carry it on into the next one because I don't want people, you know, thinking this is the longest podcast ever. I think one of my main learnings of the year, if I'm being completely candid, is the fact that one of the mistakes that I made and one of the difficulties I still have, despite, you know, doing this for nearly 30 years, is that once I've sold something, I've found all the reasons why I'm exiting this stock. I am very, very weak, right, when it comes to buying that stock back. I tend to buy a stock, hold it forever and ever and ever and ever and ever and ever. But if I get round to selling it, I'm like, no, I'm like my daughter used to be, you know, I'm done with you. Go, get away.
Yeah, it's like there's no way I can buy it again.
There's no way I can buy it again.
Yeah,
and
I know that.
Probably the best example of that. I've got two examples. I'll talk about the other one on another podcast. Is Reach Media, the newspaper company that everyone knows about, right?
RCH, yeah.
Yeah, I was on stage at the Mellow in 2019, right? And we were asked just to recommend a stock for further research, right? And I suggested Reach at 75 pence, right? And people went away and they bought it, and I bought it already at 75 pence. And I think it was about 60 or 70 pence at the time of Mellow 2019.
I remember you mentioning it, yeah.
Yeah, and it did really, really well, Pete. And it went on and went up 120, 160, blah, 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 blah. Got to, so I bought it in the May of 2019. We had the summer Mellow. Got to various different things, good news, bad news, and doing a bit of a turnaround. It got to Feb 2020, and I decided, having bought it at 75 pence, I'd trim it at £1.60. Yeah? Thought I'd done well there, including dividends. I'd made 121% on a tranche of REITs. Happy days. Congratulating myself. Right? So the shares went and came out with, because I was getting a bit nervy ahead of the full year results. And the results came out, and the latter part of February, it hit a high of 184. And obviously then all the noise is coming out about COVID, lockdown. We're talking about February, March of 2020, Pete.
Yeah.
And I was like, no, it's a great stock, it's a great stock, it's a great stock. And the market just kept battering it and battering it and battering it because it'd done so well, in the past 12 months. And the shares eventually got me to the point where I was like, I've just got, I went through all of the pain of the lockdown and the summer, and it got to the middle of the summer and I was like, no, I can't take any pain. It's gone down to about, I think it hit a low of about 65 pence, Pete. Yeah. And I rode it out, got to 74 pence, and I was like, oh, it's got back to where I'd initially bought it. Yeah. I'd already banked 121%. I thought, I'm getting out of here. So I sold it just above 74 pence.
Yeah.
Right. Eventually, Pete, in the August of 2020, right, just 1 month later.
Oh, no.
Right, 1 month later, the shares are bottomed at 50 pence or thereabouts.
Yeah.
50 pence. Remember, I bought it at 75 initially the year before, right? And I had it on my radar, my watch list, and it was there going, Conkers, I'm here at 55p now. Come and buy me. Right? I'm going, no. COVID's going to hit you. You're not going to recover. I'm back at 75p now, back where you bought it the first time round. Buy me. No, not having it. Right. COVID's still around. The market's done that whoosh, wallop back up again.
Yeah.
Move we had, right, in the summer of last year. And it's there crying at me saying, buy me. Right? I'm not having it, mate. Then we get lots of other people seeing the value and the potential of the recovery because the lockdown's not really impacting it. We're having a recovery. The markets are all happy. Everyone wants to buy REIT shares, Pete.
Yeah.
And it's now over £1, mate. And I'm still going bar humbug, right?
Yeah.
And I'm looking at the share, right? And it gets to October, mate. It's at 105.
Yeah.
And it comes out with some stellar news and this, that, and the other, and everyone's championing the stock. And essentially, I'm not going to say it's getting wrapped, but a lot of people are catching on to the wave.
Yeah.
Right. And it hits £1.65 in November 2020p. I still have not bought this stock.
And of course, by this point, it's getting even harder to buy it.
It's now getting harder to buy.
Because it's so far away from where you could have.
Absolutely.
Yeah.
So, I'm conscious of the time, folks. I'm going to cut this miserable story short of the pain that I've had to endure watching the stock.
It's a good story, but it's quite sad.
But having been able to buy it at 50p, right, in August 2020, yeah, November 2020, a mere 3.5 months later, it's at 165, right? Conkers 3, the clown, has ignored it, right? It gets to February, right? 1 year on from the capitulation of the markets, right? The share is at £2.38p.
Oh.
Right? Yeah, I'm not mad. I'm not jealous. I'm not envious. I am absolutely livid.
Yeah.
Right? And I'm thinking, can't buy it now.
There's no way you can buy it now, mate. No.
I can't buy something at £2.30 odd that I could have bought at 50p. Just can't do it. Right? And it's also now higher than when I sold the bulk of it at £1.60. Can't do it.
Yeah.
Right. So I watched the share price, Pete, peak in this year.
Yeah.
In August, right? 1 year on from when it hit the low of 50p, right?
Yeah.
In August of this year, Pete, August the 20th or something like that, 21st, it hits £4.30.
Don't. That's
Right?
Yeah.
It's rolled over a little bit now. It's at £2.70, mate. But I have missed out on a shed load of returns. It could have been an 8-bagger from the lows. And I know some people that bought it at 70, 80, 90 pence and a pound plus that have done absolutely exceptionally well. And to you and you brave souls that bought it at 50p, 70p and a pound, congratulations. But that's my story there about my learning. And what I've got to improve in 2020 is learning to buy stuff back that I appreciated before, that have gone to new lows, that may be able to recover. And if they are recovering, as you know, some of our listeners have said, find the point where it is plausible to really buy back. And that's something that at Rudyard Mike does exceptionally well. He'll go back and buy a stock half a dozen times, back in again and in and out and in and out again. You know what I mean? We've got another chap that buys stuff really, really well in and out. And that's Go Left Massa. I've got to give him a really, really big shout out
Ben.
to Ben.
Yeah.
He does exceptionally well regarding his research and stands there completely independent regarding some of his investments. But that's my weakness, folks. And it's something in 2022 I am significantly going to be working on. And I will talk about another stock that's given me lots of pain this year, and that's DDDD, 4D PHARMA. Yeah. I'll talk about that in the next podcast, but I'm not going to, talk about it now because we're 1 hour and 23 minutes in.
You can't take the sadness.
But it's just sad, Pete, because I think the problem is, and it goes back to what you said earlier about you can over-research a stock and be too wedded to a stock and wedded to the story. Yeah. And you can watch the chart go all the way up and all the way down. And if you take no action when things are ahead of where they should be, and it's a good point here, when things get ahead of where they should be, realistically, you've got to be objective. You've got to decide, actually, take some off the table. Yeah. If it goes higher, great. But at some point, anything that gets overvalued will return to a norm at some point. And sometimes that could be a low, never mind a norm. So you've got to be mindful of that. But I'll talk about that a bit more next time.
Cool. That was good, mate. We covered a lot of stuff there.
We did. I'm hoping that you guys have enjoyed that podcast. You can still add to some of the feedback that we've got regarding your learnings for this year. And we might add that into my bit next year regarding the performance of my portfolio and also my learnings, my mistakes and stuff that's gone well. Pete and I are going to try our very best to give you some suggestions to research in the next podcast as to stuff that we think. And I think we're going to focus on stuff that we do not hold as well. We'll come up with some ideas as to stuff that you could research on the next podcast that may be of value to have a look at. I think I'm going to try and find some stocks as well that might be overseas, Pete, as well.
Okay.
I've been doing a lot of research over the Christmas break on trying to diversify my portfolio, so it's not, as you say, start again, UK centric.
Yeah.
Get my teeth in.
Yeah.
Anything else you want to finally add, Pete? Last
No,
words?
I think that's great. I think we covered a lot of material. It's good. I mean, well, thank you to everyone for listening for all of 2021 and enduring this stuff. And thanks for reading my tweets and reading when I do put some on the website. I mean, as you know, I've not been too great on the health side. Hopefully for 2022, I will finally get this health problem sorted out. Now they know what it is. So thank you everybody, and I hope you'll have a great 2022.
Cool. I want to repeat that as well. I want to thank everybody that supported us, everyone that's given us feedback, good, bad, or indifferent. As I always say, the beauty of this podcast is that we're improving, we're tweaking, we're looking to improve, and we're doing that because of what you are sharing with us and what you're telling us to do, and we're going to keep trying to improve it. I would say this to everybody, there is always room for improvement. The biggest room for improvement is the room for improvement, and we will strive to make this a better podcast for you. Thanks to everybody that's made donations. If you can make a donation to the Twin Petes Challenge, please do so. If you can do anything possible for your neighbours, your community, please do so. I am going to be having a hardcore rave on New Year's Eve. None of you are invited. It's just my two bosses and I. We're going to be in the front room, waking up our neighbours, and we're going to be stomping right through until we listen to Jules Holland, and then we're going to crack on again until the wee small hours of 2022 appear. I want to wish all of you guys, ladies, gents, a fantastic New Year's Eve, fantastic 2022. Stay healthy, stay kind, stay blessed, and cherish everybody that you love and care for. Take care. See you guys soon. And Pete and I will look forward to see some of you guys face to face. Ladies and gents, take care. Love you lots. Bye for now.
Stay lucky.
This TwinPetes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.